most modern portfolio theorists look at risk, they don't measure risk with volatility. So because they don't measure risk from volatility, they don't really look at correlations between asset classes, meaning the volatility correlations between asset classes. So because they don't think of it risk with volatility, they don't really accept the correlation arguments and having different correlated assets to decrease volatility. They believe they decrease volatility, which, like you discussed earlier, with more of a margin of safety and not losing money and seeking absolute returns versus relative performance. So I would kind of just throw out there that I probably don't believe that they look at modern portfolio theory. The true value investors, I don't think they look at it very much. They just look for bargain bargain securities wherever they can locate them. They don't have to be necessarily in many different asset classes. I mean, they like some diversity, but they're just looking for bargains, and they may all come from a couple of sectors at any one time when they're looking at that. So it's just different ways of looking at it. I personally don't believe they look at it at all, the true value investors, because they don't measure risk with volatility.
Mm-hmm. So, yes, I agree with that. So I think that for the true value investors, they don't care about the allocation part. So they just believe if they find a good bargain and then they will invest at a good price and then wait long enough to see the price appreciate.
Yes,
so
I think that's how they.
I'm sorry, go ahead.
That's how they think about it, correct? Because they don't believe in modern portfolio theory.
Okay. And because all of the portfolio are good investments, margin of safety larger than 33% of the intrinsic value. And
you had everything right. You had everything right. I think I was just trying to throw that out there just to give you kind of a deeper value sense of how they think. You know, I know it's hard to make a big adjustment into a different way of thinking than you were trained and taught and so on and so forth. But I just wanted to kind of throw that out there. But no, great presentation. You did a really good job.
I think you're right, yes. So, yeah, I agree with that. By the way, so what's your opinion on the Russell 2000 lowest volatility? Because the reason I gave might not be the true, and because
what was your reasoning again?
Well, my reason was because during the economic downturn, that people are afraid to lose money, so they would put their money in a safer market, such as bond market or large cap companies. So if I invest in Walmart, right, so the Walmart will not go bankrupt in one day or in several weeks. So it's kind of safe investment.
Well, Russell 2000 has a lot of small cap companies included.
Right.
The small cap index.
So, because my reason was because they are small cap companies, so there might be a higher risk, a higher possibility that those companies will go bankrupt during the economic downturn.
Yeah, so you would kind of expect a higher volatility with the small cap companies, wouldn't you?
Well,
historically, small caps have been more volatile than large cap. Yeah.
But if they just not invest in those small cap companies, then the price will not move up and down that frequently when as compared to the time when market is doing good, right?
Yeah, say that again. I'm sorry, just the connection is not super great. I can't.
Oh, sorry. So when the market is going down, right? So they probably will not invest in those small cap companies, right? So if there's not a lot of transactions, then the price of the small cap companies may just stay the same over a long period of time. Right?
That could possibly be a reason. The other reason is maybe small caps tend to have outsized growth than large caps. So a few small caps that may go 200%, 300%, 400% in a couple of years, which usually never happens to an S&P 500 company. I think you have maybe a lot of outperformers among small caps that skew the data to make it appear less volatile, because you might have quite a few big winners that more than compensate for the losers. So in other words, if a loser goes down 75%, you can have a few big winners that go 400, 500, 600, 700% in a short time, which actually smooth out the volatility overall as a general index. But any individual security probably has a higher volatility than any individual security on average in the S&P 500. But I think when you look at it overall as an index, I can see why it might show a lower volatility, because you have a lot of outliers, a lot of stocks that go up significant amounts among the small cap group.
Yes, that's true. Yes.
Possibly another view on it.
Yes, yes. Also, sometimes that small cap companies, when they present a good opportunity for value investors, they would just maybe go in and purchase a large stake of stock of the company, and then eventually, when the price increases, and then they will be able to make a lot of money, and also the return will be relatively significantly higher than its peers. So I agree with what you said.
I think in general. Yeah, but I think in general, looking at volatility in the SI index and saying it's lower, therefore lower risk, higher return, I'd say that's probably the wrong way to compare. I don't think value investors really care what their volatility is. They're so long term, and if they buy a bargain issue, they're more than likely it's going to go down a lot more after they buy it, and they sell it years and years later when it goes up a lot. So maybe they can end up with a pretty high volatility depending on how concentrated their portfolio is. But once again, they don't measure risk by volatility. They measure risk by not knowing what they're doing and a permanent loss of capital. That's how a value investor looks at risk, not based on volatility. So it's nice that you compare it and you show lower risk and higher return, but I don't think a value investor would even really see that as a benefit to his approach. I don't think they really are too concerned with volatility, since that's more of a modern portfolio, efficient market hypothesis type of modern portfolio theory type of way of looking at things.
Okay. Yes, I would agree. Yeah.
But it was a great presentation. It's a tough concept to grasp. I think Seth Klarman says it very well. It's a philosophy. It's a hard one to go and put in mechanical figures like low PE, low price to book, because price to book doesn't mean much anymore. It used to mean a lot. Or looking at high dividends, value stocks tend to have a little higher dividend, but I don't think value investing, while it looks like they look for those kind of stocks, I think there's so many different styles of value investing. It's more of a comprehensive philosophy, I think, as Carmen said, where you are looking at fundamental analysis, but you're also looking at long-term cash flows. You're looking at a quality of earnings that are sustainable and high quality, and a lot of other factors go in. I think it's kind of an art more than a science, where I'd say modern portfolio theory is more of a science than an art.
Right, I agree.
Yeah, that's good. Well, Dean, we really appreciate your presentation. We're going to wrap this one up here for today. Then we're going to review the tapes here. But do you have any other questions or anything else you want to add?
You mean about this presentation or about the job?
Just anything, not the job, but just about anything you found. What did you really get out of this? What was the best thing that you walked away from doing this presentation?
Okay. I have no more questions.
Okay.
Good. Thank you.
Sounds good.
Thank you.
All right. Thanks, guys.
All right.
Thanks, guys.